Last class we talked about pricing for insurance and the importance that capital plays. And we talked about the required capital, how much net worth does a firm need to hold, and what should the break between debt and equity be. So this term capital is very, very important. Anytime you see this term, how much capital should a firm use? Should they use debt? Should they use equity? How much equity should they need? Miller-Modigliani comes up. I just want to real quickly make sure everyone has some exposure to this theory. You can definitely look it up. There's plenty of websites, but just very, very quickly, we note that the cost of capital, also known as WACC, the weighted average cost of capital. Hopefully you've had this in a class before. And this is the simple formula, equals the weight of debt times the cost of debt plus the weight of equity times the cost of equity. And then we know that interest expense is tax deductible, so we usually reduce the cost of debt by 1 minus the tax rate. Another way we can write this is WD times KD times 1 minus the tax rate plus WE, weight of equity, times KE, cost of equity. That's it. So the question is, so a few things to say about this theory is, first of all, the cost of debt will always be less than the cost of equity. So this implies if you increase WD, WACC would come down, all else equal, but all else is not equal. And the reason for that is because when you increase KD, beta rises, and so KE rises. And if you remember, KE equals the risk-free rate. We talked about this earlier when we were talking about Warren Buffett, or not Warren Buffett. We're talking about oh gosh, what theory was? Oh, the whether or not corporations should buy insurance, plus beta times the market risk premium. So when you increase debt, beta rises. Firms with more debt have a higher beta. Hopefully you saw this in a previous finance class. So your cost of equity rises. As such, before taxes, increasing WD increases beta and KE, and WACC does not change. So the theory of Miller-Modigliani is before taxes, switching out of equity, even though it's more expensive equity, into cheaper debt does not reduce your cost of capital, because as you use more debt, your cost of equity increases to the point where your WACC really doesn't change. However, after tax, increasing WD increases the tax shield, and this is an important term, the tax shield of debt, such that WACC declines, and that increases the value of the firm, increasing the value of the firm. And an important concept here is firm value is maximized where WACC is minimized. Hopefully you've had that very important financial concept. I encourage you to go out and read some Wikipedia or Investopedia. All you have to do is look up optimal. You just look up the term optimal capital structure, and you can do Investopedia or Wikipedia, and you will see really good explanations of everything we're talking about here. But but it's key that increasing the weight of debt, having more debt and less equity in your capital structure, increases the value of the firm only because of the tax shield. At some point, increasing WD increases the risk of bankruptcy, and WACC starts rising again. So what you're trying to do when you're trying to maximize the value of the firm is you want to use enough debt that you maximize that tax shield, but don't use so much debt that the investors, employees, vendors start worrying about the firm going under. So if you're not at all familiar with this theory, make sure you read about it before you graduate. This is one of those theories every finance major, every actuarial science major should know very, very well. You should have seen it in your very first finance class and probably seen it in a couple of others as well. This graph shows that equation. So what they're showing here on the y-axis, it's not marked, but this is cost of capital. This is the weighted average cost of capital. And what they're showing down here, they say call it gearing. I'm not familiar with calling it gearing. That's kind of a strange phrase, but just asking how much debt do you have. As you move to the right, you have more debt. And you'll notice the cost of capital comes down as you add more debt, and it's only doing that because of the tax shield. That's the only reason this line is coming down. At some point, you have so much debt that people start worrying about the firm's financial stability, whether it might go bankrupt. Its cost of debt at some point starts rising really rapidly, such that the WACC goes up. So where you want to be is at the minimum WACC, where the WACC is minimum, where the cost of capital is minimum. That's where the value of the firm is the highest. As you increase your weight of debt, your cost of equity goes up. If we did this chart without bankruptcy and without taxes, increasing the amount of debt would increase your KE such that your WACC would not change, because you're switching out of expensive equity into cheaper debt, but because the cost of equity is rising as beta rises as you increase your debt, WACC is just a straight line all the way across. So the only reason WACC is coming down is because the tax code makes interest expense tax deductible. So that's a very, very quick review of cost of capital and the Miller-Benigliani theorem. So you can actually, you just type in optimal capital structure. If you click on images, there's several images that will come up. The ones I've been showing you, you see those a lot. Another approach you'll see is this approach. In this approach, they don't show the cost of capital on the y-axis. Instead, they show the value of the firm. And what they're showing is you increase debt, the value of the firm increases because of the tax shield of debt. But at some point, that value starts diminishing because of bankruptcy risk. And so the value of the firm is not maximized at the maximum debt. The maximum value of the firm is not where you have 99.999% in debt, so you maximize that tax shield, because at some point you start seeing some detriment to the firm because of bankruptcy costs. So that's the theory. You can also type in, Wikipedia, and they'll have a capital structure discussion. There's Miller-Benigliani right there, and they'll go through it in detail. Or you can do Investopedia has a discussion. Investopedia might be the one to start with, a simpler one. So they'll both address Miller-Benigliani in their theorem, and then you have the weighted average cost of capital. So it's all in there just in case you have not been exposed to that theory. So I'm using some terms that I'm assuming you've seen before. And so when we get to a financial firm like a bank or insurance company, capital is a little bit different. For non-financial firms, optimal capital structure is debt versus equity. So when we get to financial firms, it's really, capital really is just net worth. So if you look down here, for most firms with Miller-Benigliani, capital is both debt and equity. Usually with financial firms, When I use the term capital, and most people use the word capital for a bank or for an insurance company, mean only the net worth, only the equity. And that's mainly because most banks and insurance companies don't really rely on debt as much as they rely on their policyholders and their depositors. So a bank, most of the bank's funding will come from deposits, savings accounts, checking accounts, certificates of deposits. Most insurance companies, they don't have debt, instead they have reserves. So that's why it's a little bit different. So let's be real careful. We talk about cost of capital, we talk about required capital, optimal capital structure, that's how much debt versus equity. Those are all terms that you should have seen in your first finance class. I just want to make it real clear for financial firms. When we say capital, we really are focused just on the net worth, just on the equity part. Does the firm have sufficient net worth for their risk? And so with financial firms, the question is, how large is your net worth relative to your risk? So banks have something called Tier 1 capital, or risk-weighted capital, and what they do is they look at how risky their assets are, and based on the riskiness of their assets, it will tell them how much net worth they have. Insurers, we'll talk about this one later, risk-based capital is what we use in insurance. We'll look at the risk-based capital rules and how they're set up, and again, it tells an insurance company how much net worth they need relative to the risk that they're taking. But again, the words capital in both places reference only the net worth of the firm. So I just don't want people to get confused when I use the word capital. So we've already seen this formula for insurance companies. So real key here, what we're talking, let's just set this up. So let me step back so we make sure we have it in place. The premium that an insurance company charges is going to be the pure premium. Remember, the pure premium covers only the claims the insurance company has. And that's the premium we're going to look at. Plus expenses on a present value basis, present value of expenses, plus profit. Profit is going to equal the required return, rate of return. Here we're talking on equity, times the required capital, and here by capital we're really talking about net worth. Alright, so the premium we're going to charge is going to be a pure premium. That's the present value of claims, what we're going to pay out in claims, the present value of our expenses, plus the profit. Our profit is going to be a required return on equity times our required capital. How much net worth do we need to owe? And that net worth is probably going to be based on a risk-based capital formula. We'll talk about some different formulas. And when we do pricing, in our example, when we do pricing, we are going to we're going to use a very simple risk-based capital approach, overly simplified, but I'll show you the more complex risk-based capital formula. So the profit side of this equation, so this is, the problem is I broke this between two classes, so I'm just trying to set the foundation for what we covered in the previous class. So the profit side of the equation is required return on equity times required equity. So to require return on equity, we can use the capital asset pricing model. The only question is, what is the beta for insurance companies? So when I worked at UTSA, I worked with the actuaries, and my goal was to actually come up with that required return on equity. I used the capital asset pricing model. And for you actuarial science majors in the class, you're saying, well, I'm actuary, I don't need to worry about this. I worked with P&C actuaries, and they knew the capital asset pricing model as well as I did. They must have seen it in their studies, especially when they got into studies on insurance pricing. And we had a pretty good debate. It was really fun talking to them because, boy, they knew it better than most finance majors I know. They could really get into it in a very interesting way. So what is a beta of an insurance company? Betas of an insurance company tend to range from 0.9 to 1.2. If we go into Yahoo Finance and we click in and let's just see, I'm just curious. Let's do Allstate. and you just look at these firms and see what beta they're reported, you can see for Allstate the beta they report is 0.93. Now that's just their historical calculated beta for the last 5 years using monthly data, but 0.93 seems reasonable. Allstate is a personal lines rider, so it makes sense that their beta be below 1. They're not a commercial rider. Here's Hartford, so let's look at Chubb. So you look at Chubb, yeah, their beta is shown at 0.63. That's an artificially low beta. That doesn't make sense. Look at Progressive, or let's look at Hartford. Hartford's a commercial rider. Their beta is above 1. That makes sense for a commercial rider to have a beta above 1. But you see, we're not radically off. The Progressive might have a lower beta. Let's see. Yeah, I don't think it's 0.56. That'd be like a grocery store. You know, usually insurance companies, I really think they're between 0.9 and 1.2. I don't trust, some of you have had me for other classes know I don't trust the betas reported in Yahoo Finance because betas are very unstable and they go all over the place. So I would definitely not use a 0.56, but I might use a lower beta for Progressive than I do for Allstate because Progressive only does auto insurance. And since Allstate does homeowners insurance that is exposed to large catastrophic losses that can drive markets and can have an impact on the stock market, I would assume a little bit higher beta for Allstate. But my opinion, no matter what Yahoo Finance shows, because they're very unstable, the numbers are all over the place, I would normally use a beta in the 0.9 to 1.2 range. So remember beta, this is real important. We talked about beta as a measure of systematic risk. Those risks the company have that are closely tied to the overall economy. And so on the liability side of the insurer is typically uncorrelated. And it might even be negatively correlated. You take right now, we have the coronavirus. So people are working from home. Well, auto insurers are seeing much lower claims right now because people are driving a lot less than they were before. So you have something that the stock market's crashing, and yet you're seeing insurance companies having much lower claims. So there's a negative correlation there. That implies a low beta. And most of what we talked about this when we talked about why corporations shouldn't buy insurance. Insurance companies mainly insure unsystematic risk, which means the liability side of their balance sheets tend to be uncorrelated and maybe even slightly negatively correlated. The one exception to this that we'll talk about later is inflation. Inflation can impact the liability side and does impact markets, but it's kind of a second order of magnitude kind of thing. The asset side is insurance companies own a lot of bonds. They do, and property and casualty insurance companies do own stocks. That pushes you to higher beta because obviously if you're investing in the stock and bond market, you have a lot of systematic risk. So if the beta of the market is 1, I would put insurance companies generally in the 0.9 to 1.2, depending on the business. The more commercial they are, commercial writers, the more likely they are to be above 1. The more personal lines they are, the lower below 1 they are, and the more they're just pure auto insurance and not doing auto and home, I would even give it a slightly lower beta. But it's definitely open to debate. You can look at the historical numbers. I don't like looking at just the last 5 years like they do in Yahoo Finance. I like doing a rolling 5-year and just look over the last 10, 15, 20 years or even longer if you can, and just get a sense of what that range could be. So the required return reflects the systematic risk of the company. It's risk-adjusted returns, so we're going to use a beta in 0.9 to 1.2, so a return comparable to what you would expect by the overall stock market. And we've already talked about here, so systematic risk. So there is some exposure to the insurance industry to inflation and commodity prices, but some of it's actually negative correlation. When oil prices go up and gasoline prices go up, people tend to drive a little bit less, and that helps auto insurers. You know, so it just depends. There's definitely, for homeowners, if there's a major catastrophe, the commodity prices of wood and concrete and steel are going to be impacted. So there is some relationship, but it's not a perfect relationship. All right, let's talk a little bit about required equity in our next session. So we'll stop it there, and next session we'll talk about required equity. And I'm going to bring in a little bit of the risk-based capital into this. We'll get into risk-based capital a little more detail later when we talk about regulation, but for right now I'll introduce it at the high level so you can see how we determine how much net worth a firm needs.